Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals in our 26th year in business. It's midday, Thursday, July 2nd, 2015, and the title of this week's audio blog is Massively Important Topics Ahead of This Weekend's Greek Referendum. Well, I was supposed to be done for the weekend, as after all, it is a holiday. However, given the political, economic, and financial carnage the world is amidst, as the end game of history's largest, most destructive fiat currency scheme approaches, I feel both the burden and honor of commentating to the world's truth seekers, who frankly are the reason I love my job so much. To wit, so many people have no outlet for their angst about the ugly, irreversible direction the world's economy is taking, whilst I, from my platform as Miles Franklin's marketing director, have the ability to communicate with thousands, if not tens of thousands, of like-minded people each day. To that end, despite the unrelenting suppression of prices over a now 4-year period, the Miles Franklin blog gets little, if any, negative feedback. In my view, this is due to the fact that we simply tell it like it is, and despite our business of buying, selling, and storing precious metals, it is our passion for sharing our experience and insights with readers and listeners that is the principal force behind our mission statement. And even when someone disagrees with us, such as an email I received disagreeing that Greece is likely to Grexit, such messages are typically considerate, thoughtful, and amenable to response. Frankly, the majority of the negative feedback I've received over the years, which lately has all but disappeared, was from overseas. Coincidentally, overseas gold prices have risen sharply over the last 12 months, care of the collapse in currencies caused by the Fed exportation of inflation I first predicted in December 2013. In other words, the higher prices go, the less critical readers become. That said, we clearly have our largest readership base in the States, and thus the fact that not only do we have little if any negative feedback here, but that our unsubscribe rate has substantially declined, is because cartel suppression irrespective, our American readers understand that what we are writing on is dead-on truth, and that without rigged financial markets, gold and silver prices would be many multiples higher than they are today. Which, of course, is exactly where they will be when economic Mother Nature inevitably destroys the historic but ultimately unsustainable manipulative forces that have temporarily usurped her, at least when it comes to last-to-go markets like the Dow Jones Propaganda Average and paper gold and silver, as opposed to the countless other markets she has already reconquered, like commodities, currencies, and selected bond markets. And oh yeah, the historic PBOC-fostered Chinese equity bubble, which after suckering in tens of thousands of retail accounts, actually millions, 5 million to be exact, on hundreds of billions of dollars of margin, en route to a 150% gain in just 10 months amidst the most horrific Chinese economic implosion in 4 decades, has now plunged an incredible 25% in just 2 weeks. And this, despite not only the PBOC's first simultaneous rate cut and reserve requirement decrease since the 2008 crisis, but yesterday's government ban on negative commentary about the stock market. And by the way, trust me, this burgeoning financial disaster will have widespread global ramifications. First, as China's economic miracle continues to collapse into the ether, and second, as the PBOC accelerates its maniacal and miserably failing QE program. Speaking of expanded QE, don't for a second let yourself be fooled into believing it's event-driven, i.e. that central banks will only increase money printing and asset monetization due to events like the Greek debt crisis or Chinese stock market crash, although certainly they give central banks an excuse to do so. To the contrary, the real reason ZERP, NERP, and QE continue to grow is the simple fact that the fiat currency regimes underlying them are, by definition, Ponzi schemes that must grow infinitely and exponentially to survive, with the caveat that the larger they grow, spawning more and more debt, inflation, and wealth inequality, the more likely they are to suffer the crisis of confidence that has proved the undoing of countless hundreds of schemes like it, with, over the course of history, not a single exception. In the current global scenario, we are well past the point of no return, as well as the point where the diminishing returns inherent in all money printing schemes become decidedly negative. In other words, with each dollar, euro, yen, and yuan printed, the world is quantitatively worse off. I mean, just look at this year's headlines of no less than 24 central banks lowering rates, with just this week alone the Chinese taking the aforementioned suicidal steps, Whilst the ECB expanded the universe of securities eligible for its own open-ended, recently increased QE program, and in Sweden, the Riksbank not only reduced interest rates from negative 0.25% to negative 0.35% this morning, but increased the level of its ongoing QE program. And why, you ask? Because it can't get rates low enough, no matter how hard it tries, and thus can't get the Swedish krona to decline against the euro, which, as you can imagine, will likely require far lower rates and far more QE, given that the euro is on the verge of all-out collapse. To that end, it should be quite obvious why manipulation of not just interest rates, but all financial markets has become paramount, particularly since the point of no return I referred to as mid-2011, when Western central banks realized their haphazard post-2008 money printing orgy was failing, and decided that covert commandeering of everything from stocks to bonds to precious metals was their only chance of averting immediate destruction at the hands of economic Mother Nature. And nowhere more so than gold and silver, where mere words are no longer sufficient to describe their daily machinations. Clearly, gold and silver are the mortal enemy of fiat-supporting central bankers, to the point they are now suppressed every second of every day, from the second Asian paper markets open Sunday night at 6 p.m. Eastern Standard Time to the second the weekend commences Friday afternoon at 4 p.m. Eastern Standard Time. To that end, I see that the perennial precious metal antagonistic, fence-straddling commentator Barry Ritholtz, who now works for one of the top MSM lackeys, Bloomberg, yesterday wrote an article of how gold is, quote, shrugging off Armageddon. Like Harry Dent, Larry Edelson, and other sensationalistic, trend-following writers, his lack of cogent analysis is beyond astonishing. To that end, I urge you to read the response of the great Chris Powell of GATA, titled, Is Gold Shrugging Off Armageddon, or Just Being Shrugged Off?, in which he simply highlights a half-dozen proven facts regarding central bank gold manipulation, which according to supposed analysts like Ritholtz is either untrue, despite reams of evidence pointing to it, or inconsequential. You know, like the rigging of LIBOR, mortgage-backed bonds, or according to yesterday's Department of Justice announcement, airline fare pricing. In fact, the hideous suppression of precious metals has become so all-encompassing, and this amidst an environment of record global demand, plunging inventories, and stratospheric fundamental factors, that the entire gold and silver mining industry is on the verge of implosion, which frankly I view to be a fait accompli at this point, unless prices dramatically increase in the very near term, and I do mean dramatically. Believe me, there are few people with as much first-hand knowledge of the carnage wrought by the cartel and its bullion bank minions as myself, as well as hangers-on in the hedge fund and high-frequency trading industry, who have simply learned to exploit the cartel's blatantly obvious trading patterns, like capping and or attacking gold on 104 of the last 106 Sunday nights, or at the 2:15 a.m. Eastern Standard Time open of the London paper pre-market session on 467 of the last 532 trading days, or for that matter, other key attack times like the 8:20 a.m. Eastern Standard Time COMEX Open, the 10 a.m. Eastern Standard Time close of global physical markets, the 12 o'clock p.m. Eastern Standard Time cap of last resort, the 2 o'clock p.m. Eastern Time crybaby time if all else fails, and of course, the 6 o'clock p.m. Eastern Standard Time open of the thinly traded Globex paper platform, which for several hours trades with not a single actual exchange open. This, by the way, was the launchpad of several major cartel attacks over the years, none more infamous than the May 1st, 2011 Sunday night paper silver massacre, with China closed for a holiday, no less. Yes, I've seen it all in the beleaguered precious metal mining industry, from the time I purchased my first mining stock in May 2002 until I sold my last in July 2011, and left the mining industry in October 2011, where I had worked in corporate development and investor relations for the prior 5 years. Over those 9 years, not to mention the subsequent 4 years of watching each and every stock and each and every development, it became painfully clear that miners were targeted just as viciously as gold and silver themselves, if only because they are such effective tools at quashing precious metal sentiment and at the same time destroying potential PM buyers, especially those crazy enough to have bought mining stocks on margin. On average, I'd venture to say, no pun intended given how most junior miners list on the TSX Venture Exchange, that the average, quote, junior is down at least 90% since the sector peaked in 2007. Yes, 2007, 4 years before gold and silver peaked. And as for the average major, I think the Huey's 76% plunge since its early 2011 peak is par for the course, which, by the way, is now 24% below its 2008 low, when cartel raids at the height of the 2008 crisis pushed paper gold and silver prices, respectively, to $770 an ounce and $9 an ounce, compared to today's $11.65 per ounce and $15.60 per ounce. Back to juniors, I think the term is greatly misused, in that no more than 5% of all junior miners actually mine anything at all, or for that fact are even close to doing so. No, more than 90% of all such companies are simply exploration companies, which I can tell you from personal experience ran out of capital to do anything but keep the lights on when I exited the mining industry 4 years ago. Today, as I predicted, perhaps 75% of all such companies are either dead, on life support, or are simply empty shells trading for pennies on pink sheets. Consequently, when combined with the fact that, like oil, all the great low-cost gold and silver deposits have already been found, there have been essentially zero major discoveries for the past 2 decades, which is a major reason why reserves have been declining for years, with nowhere to go but down, let alone the so-called resources that have little chance of being developed in the best of times, which are validating in spades what I espoused in February 23rd's quite apropos audio blog, What's More Fraudulent, Mining Resources or the Greek Debt Deal? Trust me, between working as either a consultant or officer of dozens of junior miners, in which I visited operating mines, exploration sites, and mine developments the world round, attended dozens of mining conferences for both industry and investors, visited with some of the world's leading mining-focused hedge funds, and negotiated with some of the largest mining financiers, it became painfully obvious this industry was not only one of the most difficult to succeed in during the best of times, but clearly marked for death by a cartel that can naked short as many shares as it needs to destroy it, which it decidedly has. In fact, I was writing publicly of these dangers even when still in the mining industry, and the second Miles Franklin liberated me in October 2011, I expanded my warnings of the risks of mining stocks and other paper PM investments exponentially, such as, for instance, my February 2013 article titled Precious Metal Mining Closed-End Bullion Funds, Helping or Harming, in which I espoused that the cartel would naked short them into oblivion to ensure they trade at discounts to net asset value and thus prevent the fund's owners from executing the secondary offerings required to fund future physical metal purchases. Back then, I opined that at least 3/4 of the exploration industry would be destroyed by now, which frankly likely understates what has actually occurred. As for actual junior miners, that actually produce gold and silver, I guess no more than a handful actually make any material amount of money. And of those, most have very little cash on hand, with no ability to increase or even maintain reserves. In other words, barely hanging on and inching closer to financial distress with each passing day of prices at or below not only their cost of production, but the industry's long-term cost of sustainability. As for the majors, they have become Wall Street pariahs, not just due to weak cartel-suppressed prices, but pathetic management and an inability to even address the fact that prices are being illegally manipulated. Like prices falling in the same manner at the same times every single day, concentrated silver shorts 15 times more than in any other commodity, or open interest on the criminal comics exchange well in excess of available supply. Consequently, their reputations have plunged as rapidly as their earnings, reserves, resources, and stock prices, to the point that clearly industry-wide production has peaked, with a very strong likelihood of dramatically declining for the foreseeable future, let alone in silver, where the base metal prices are now falling as well, and that's where the base metal mines is where 2/3 of all the world's silver comes from. Which is probably why the principal game plan of most of the leading major miners this year is selling assets to reduce debt, and why at current prices, my prediction of a massive industry-wide consolidation yielding equally massive capital expenditure, production, and employment reductions is itself a fait accompli, starting most likely with the long-discussed merger of the world's 2 largest gold miners, Barrick and Newmont, which frankly has only not occurred yet due to the huge shareholder-unfriendly egos of its respective managements. As I watch many major mining stocks collapse in a manner barely a notch above Lehman, Fannie Mae, and Bear Stearns, I have little doubt that if the cartel isn't broken by year-end, there will be major bankruptcy announcements by early next year, particularly when year-end reserve revisions yield massive equity write-offs. To that end, in articles such as February's Initial Mining Earnings Essentially Confirm Peak Gold and last month's Mining Industry Implosion Approaches DEFCON 1, among others, I have made it crystal clear that a broad swath of companies are on death's door, starting with the South African gold miners, which are amongst the world's highest cost producers, particularly now that the rand currency is in free fall. To that end, I wrote in February 2013 of the rise and fall of South African mining, and today, with South Africa still the world's fifth largest gold producing nation, it appears to be within a few more months of cartel-suppressed prices of implosion. This week alone, the stocks of AngloGold, Goldfields, and Harmony, i.e. the world's third, seventh, and eighth largest gold miners, are down roughly 10%, taking their overall losses toward 95%. Meanwhile, the world's fifth largest gold miner, Kinross, is falling equally dramatically, as are countless others, from Coeur d'Alene to Yamana, Hecla, IAMGOLD, and Eldorado. And these are just the public companies that have the low-cost mines. For those owning mining stocks, as well as futures, ETFs, closed-end funds, and other paper PM investments, as opposed to inert physical metal, I can only wish you luck that they don't complete the mission the cartel inadvertently created for them 8 years ago. As for those that have eschewed speculating on such investments in lieu of saving physical metal, please understand that the worse it gets for miners, the better it gets for the supply-demand imbalance, which has already reached historic proportions. Okay, next topic, which is the catastrophic collapse of the U.S. economy, no matter how hard the powers that be fight to rig markets, data, and perception. To that end, even before today's historically horrific NFP employment report, we had been treated to a litany of hideous economic reports since Monday morning, including motor vehicle sales, ISM and PMI manufacturing indices, mortgage applications, challenger job cuts, and of course this morning's May factory orders figure, which plummeted by 1.0% for May and 8% year over year, i.e. the biggest annual drop since 2008. That said, we have been conditioned by years of market manipulation to believe the only economic data that matters is NFP employment, despite the fact that it has been so horribly discredited by years of blatant accounting chicanery. Not to mention the blindingly wide chasm between what it purports labor market health to be and what is really the case. Let alone as the very same Bureau of Labor Statistics that now double seasonally adjusts GDP data creates it, calling into question just how much additional data fudging has been added to the NFP data. That said, this morning's report, despite the comical headline numbers of 223,000 jobs created and a multi-year low unemployment rate of 5.3%, represented the sum of all fears to an establishment desperate to depict the recovery that has eluded all but government-rigged stock prices, and rationalize the minuscule quarter-point rate increase the Fed so desperately wants to enact to, quote, prove QE worked. To wit, not only were the previous 2 months' job figures revised down by a cumulative 60,000 jobs, yet again proving that nothing reported should be taken at face value, but the accompanying household survey depicted a 56,000 job decline during June. And then there's those oh-so-horrible internals, which as usual depicted a labor force in utter freefall from all imaginable angles. For one, 109,000 of the so-called 237,000 new June jobs were a product of the imaginary birth-death algorithm, as were 426,000 of the so-called 441,000 jobs created in April and May combined. Worse yet, said household survey reported that a whopping 349,000 full-time jobs were lost in June, offset by 161,000 part-time jobs gained. In other words, more of the same labor market hell that has characterized America for years, which is probably why the zero wage growth gains reported were likely overstated. Heck, when 14 million manufacturing jobs have been lost since 2007 and 14 million waiter and bartender jobs have replaced them, you can see why real wages continue an irreversible downward trend that started 4 decades ago. In fact, the total amount of full-time jobs is still 800,000 below the 2007 peak. And this, whilst the U.S. population has increased by nearly 18 million people. Which brings us to the ugliest aspect of the June NFP report yet, i.e. the massive 0.3% decline in the labor participation rate to its lowest level in 38 years, which laughably is why the headline unemployment rate declined, despite an incredible 640,000 people. No, that is not a typo. 640,000 people left the labor force in June alone. In fact, on a percentage basis, June's 0.5% labor participation rate decline is the second largest in 20 years, exceeded only by December 2009. And thus, if anyone still actually believes we're in a recovery, let alone following this week's ugly stock, currency, and commodities declines, there is little doubt you are either working for the powers that be, delusional, or incapable of simple mathematical functions. And this from economic data that unquestionably is rigged upward, and thus significantly weaker than reported. Not that it's a coincidence that such data emerged when, for the third time in 2 weeks, the benchmark 10-year Treasury yield was about to breach 2.5%, including this morning when it reached 2.48% just before the NFP report was released, as opposed to 2.37% as I write 4 hours later. Last week, I nearly wrote an article titled 2.5% Enough Said to follow up my January 2014 article titled 3.0% Enough Said, in which I discussed how the Fed was blatantly capping the 10-year yield at 3.0% so as to prevent the economic, financial, and subsequently political damage that would occur if said key round number was breached. Well, here we are 18 months later, and the economic maelstrom is so pronounced they have lowered their line in the sand to 2.5%, which of course entails not only massive covert QE, but the purposeful downward embellishment of economic data whenever possible to make sure rates don't surge. Not that the trend is their friend, as rates have been gradually rising throughout months of miserable economic data now on a worldwide basis. However, there's no way they're going to fuel that fire with Europe, Puerto Rico, China, and Brazil, among others, on the edge of the abyss, much less with oil prices falling anew, of which the ramifications of such were discussed in my October article, Crashing Oil Prices Portend Unspeakable Horrors. True, the Fed can use such events, as discussed earlier, as built-in excuses to delay the mythical rate hikes they've threatened for 2 years, and if things get bad enough, actually use them as springboards to relaunch QE. Irrespective, there's no way the Fed and its partner, the U.S. government, are going to fan those flames with particularly blatant jobs growth enhancement. Okay, last but not least, the upcoming Greek referendum on Sunday, which laughably was initially to accept or reject a specific Troika deal, but today is simply to accept or reject the concept of a potential Troika deal, given that none currently have been proposed. I have been on the record as saying the odds of it passing are slim to none, and as I vociferously noted in my must-hear Kerry Lutz podcast yesterday, as well as several articles last week, I believe Alexis Tsipras has brilliantly gamed the Troika, maintaining his constituents' defiance of new suicidal bailouts and austerity schemes, whilst buying time for his people to empty their bank accounts and ultimately putting the decision to remain in the Eurozone and Euro currency and pay off the nation's unpayable debts in their hands. To that end, Tsipras personally went on national television yesterday to plead for the very citizens that voted for him in 5 months ago to vote no, whilst his right-hand man, Finance Minister Yanis Varoufakis, said he'd rather, quote, cut off his arm than vote yes. Thus, when Monday morning rolls around, we could be looking at an entirely different world. Unlike Scotland or Switzerland, the powers that be have no way of influencing the result one bit. Frankly, it is difficult to believe the Greeks won't realize they are amidst their own Iceland moment, which unlike the Swiss, I expect them to embrace wholeheartedly. If they don't, another 50 billion of freshly printed euros will be added to their roughly 400 billion of existing debt, which will only drive Greece further into the abyss, prompting an even larger collapse within the next 12 months. And I assure you the world will not embrace such an event as a deal, as a solution, but instead prove positive that the euro is indeed a Ponzi scheme on the verge of collapse. Conversely, if, as I suspect, they vote no, not only will the world realize Greece's entire 400 billion euro debt will likely be defaulted, but that the other pigs and countless other nations will likely follow suit. At which point, when combined with a collapsing global economy, imploding currencies and commodities, and already sky-high social and geopolitical tension, who knows what might occur in the coming weeks and months. To which, I can only reiterate, as vehemently as possible, that the time is now to protect yourself while you still can. To that end, here at Miles Franklin, we have conducted business for 26 years without a single registered complaint, and can help you not only with the purchase, sale, or storage of precious metals, but a variety of financial planning strategies we have honed over 2 decades of working with gold and silver. Consequently, all we ask is that you give us a call at 800-822-8080 and allow our staff of professionals, on average sporting nearly 25 years of industry experience, to give you a free consultation. And as always, I can be reached via email at ahoffman@milesfranklin.com. Thanks, and have a great weekend.